Welcome to Citrin Cooperman Corner Chats. I'm Peter Katz from Westfair Communications, publishers of the Westchester County Business Journal, Fairfield County Business Journal, WAG Magazine, and digital newsletters to keep you informed. And we're going to be informed today by Steve Ronan, who is a principal and leader of the Citrin Cooperman Strategy and Business Transformation and Business Process Outsourcing Practices. Now, Steve is a real pro in the theory and execution of improving business value, and who doesn't want to see the value of their business improved? Steve has partnered with a wide range of companies, from the Fortune 100 to the middle market, to develop and implement strategies that improve profitability, create scalable businesses, and strengthen customer relationships. But no matter what the size of your business, you're sure to take away something today that will help improve how your business is going to go and how your business is going to grow. And Steve, welcome. Pleasure to have you with us.
Thanks for having me today, Peter. Great to be with you.
You know, let's begin. If you could just give us a little bit of your background, not meaning to give you a swelled head or anything like that, but just to establish some of your credentials, which are impressive.
Oh, well, thank you very much. Yes, I'd be happy to do that. So I grew up sort of at a big accounting firm, big consulting firm rather, working on value creation and what's broadly considered in that world transformation projects for very large companies. And very large companies, as you might imagine, are a little bit like turning around a cruise ship when you want to make big changes. It takes a long time. It's very expensive. It's very disruptive. It's something they need to do. Certainly, but it takes really a lot of rigor and discipline and time and investment to make it work. And when we launched this practice in the middle market a number of years ago, the real challenge was how do we get the type of discipline and rigor that it takes to execute these projects really, really well, to work for middle market companies. Because as you and I both know, the business dynamics in the middle market are much different. A lot of the businesses are family run or founder run, which have much different types of leadership dynamics than public companies with boards of directors and shareholders. The differences between the businesses can be dramatic. Even if you look at two $30 million manufacturing companies that from the outside look like they do something similar, because of the way that leadership and ownership wants to run the companies, they may be entirely different operationally. So when you start to think about leading practices or even more structured, inflexible transformation approaches, they just don't work the same way. So when you're working with small companies and middle market companies on the types of infrastructure that they need to build in order to be able to grow, drive profitability, drive scalability, you really need to look at each individual group of owners, each individual leadership team, and each individual company differently and with a fresh set of eyes, and sort of curate the solutions that are going to work for them in a much more flexible and different way than you might for a Fortune 500 company. So it's very rewarding. You can get results faster. You can execute projects in a much shorter timeline, in a more nimble fashion. But it does still take, a structured approach. It does still take an understanding of what other companies are doing in the same industry and in other industries in order to understand what the right approach is going to be for a specific company.
It's interesting that you mentioned about turning around a big ship, because we're on some pretty choppy waters. Has the COVID influence made things more difficult in what you do day to day?
Well, COVID's definitely changed the way that companies need to approach prioritizing the changes that they want to make right in their businesses. And it's definitely changed the way that we approach creating value in companies. And as you might imagine, that really depends on the industry and the market dynamics of certain companies. So we have clients in industries that have been impacted on the positive side of COVID, right? We've got companies that manufacture cleaning products, companies that manufacture home improvement types of products. These companies are doing very well right now. And the types of things that they need to prioritize are really on the growth side of the business. So how do they make sure that they have enough product to meet the demand, especially in a global environment where supply chains have been very disrupted, and it's hard to get product from countries that historically have been very stable and have had high production capacity. Other companies are facing very challenging times right now. And some of those companies are in industries that were doing really well up until the end of February. So the plans that we had for building the types of processes and systems and management teams that would allow them to continue on that growth trajectory have really been upended by COVID. And what's particularly challenging about that is we don't necessarily know what's coming next now either. So it's not like COVID changed things and we can reevaluate what the plan is and the priorities are and kind of come up with a new 12-month plan. That's not really practical right now. Most companies are now in a process where they have to model what the potential outcomes of this COVID crisis would be and understand how that influences what they're spending money on, how it influences what they're doing from a marketing perspective and a growth perspective, and potentially what they're making capital investments in. Because if a company, looks at a 6-month model for recovery and an 18-month model for recovery, that might change literally what they spend money on next week. So we're spending a lot of time working through the different scenarios with the companies that are having a tough time right now, to inform leadership with, how do we extrapolate things that we're seeing on a day-to-day basis in their marketplaces, how their customers are buying, how they need to price projects or services or products to win work, right? To at least sustain revenue and those sorts of things, and how they can look at events that may happen in the future and react to them in an appropriate way. What we really want to avoid in all situations is having to panic. And panicking and cutting expenses, or panicking and stopping, really important strategic initiatives that we had identified before COVID on a guess, right? If we have to reallocate expenses or spend in any way, we want to make sure that we're helping the companies do that in an environment that is informed by what may happen or what is likely to happen as we come out of this, whenever that might be.
Give us a clue as to what your process is. What is your thought process as you go into a company that you're seeing for the first time, as you start to look at their financial situation, as you start to look at their plans for growth or their lack of plans for growth? What is your thought process?
Yeah, so it's a really interesting topic to discuss. And this is a discussion that we have with really every prospect who comes to us that may want to engage in a project, because it's really going to depend on especially in the post-COVID world, right? What their particular business and market situation is. Broadly speaking, there's a handful of things that we want to look at up front to understand if there's anything that needs to be fixed immediately. So as an example, if a company still doesn't have a 13-week rolling cash forecast in place, we need to do that now. It doesn't really matter what all of the strategic goals should be over the next 6 months or 12 months, or what their exit timeline is, or transition, or anything like that. If you don't have one, you need one. So there's a few little very specific elements like that. You want to know where you stand on your bank covenants and your reporting. You definitely need to understand how your liquidity is likely to play out over the coming weeks, right? Which the cash forecast starts to indicate. And just some basic things like that, because from there might be just a set of improvements that need to be made right away, outside of the context of anything strategic. Specific example, you don't have a 13-week cash forecast. It takes you 25 days to close your books, and you're always making entries to prior periods. That all impacts the quality of your cash forecast. So we need to get you down to a reliable short month-end close. We need to get transactions recorded, in a close to real-time manner, as close as we can get, so that your business data is good. And then we just need to put in some basic, weekly or ongoing forecasting capabilities for you.
In a situation where a business has been disrupted, such as we're seeing, many businesses literally are on the brink of going out of business because of the COVID pandemic. Uh, is there any kind of strategy you can bring to bear that can, number one, get a company back from the brink, and number two, get them reestablished as a going concern?
Absolutely. As a firm, we've developed a framework to help companies think through what their phases of recovery are going to be. So the way that we define it is the first stage of that a company would go through in the scenario that you just outlined would be your crisis management stage. And that's really mostly about liquidity and being able to at least continue the business to operating for until you can get into some sort of recovery mode. So the PPP loans were really targeted at helping companies bridge that crisis management period. All of your banking relationship, your lines of credit, your cash management, critically, expense management. This is really all just the nuts and bolts of managing the business through the crisis. And the goal of that is to propel the company into recovery mode. And that's the phase that a lot of companies have begun to get into now. Not all sectors, but in a lot of sectors, companies have gotten at least through the immediate crisis and now are in recovery. And when you're in recovery mode, you can start to think about the business itself again and understand what the market's doing, what your competitors are doing, rethinking whether you're positioning in the market with the products and services that you sell is the right mix going forward. And it's where you have to start to think about business infrastructure and whether you have the management team, the organizational structure and people and skills and capabilities in place, whether you have got the right processes and have the expenses of those processes properly indexed to the business, and then of course whether you have the systems that can support all of this. That all happens in recovery. During recovery, you should be able to start to generate positive cash flow again, or at least have a picture of what positive cash flow and profitability look like. And the goal of recovery for this particular crisis is to get almost every company into reinvention, or what your reimagined future is going to look like. Almost every sector is likely to undergo structural changes as a result of COVID. Some of those structural changes are already happening and being institutionalized in their markets. Some have yet to do so. I mean, if you look at like what Zoom has done as a company, right? As an example, I mean, look what we're doing right now. This is going to be happening a lot more in 2022 than it was happening in 2017, guaranteed, right? So we already kind of understand that there is a structural change to all of the technologies, all of the infrastructure that enables this kind of remote work model. I think commercial real estate is probably similar, right? Depending on the metro area that you're in, there are already structural changes starting to take hold in the marketplace. When you look at like a manufacturer, depending on your subsector, I'm not sure we totally know what those structural changes in manufacturing are going to be. If you're a consumer products company, are people's buying habits going to stay the same? I mean, we really don't know. Even the home product spike that we've seen is great for these home products companies right now. Whether it's sustainable or not, I think has yet to be established, and whether buying habits return to normal. So each company that's undergoing that disruption that you mentioned is going to have to reimagine themselves in this new reality. They're going to have to reimagine their go-to-market and their strategy. They're really going to have to reimagine the way that they operate. And that could be as small a change as, new approaches to shift management and new approaches to, scheduling and demand planning, to, managing fully remote back offices or outsourcing more, managing fully remote sales teams, these sorts of things. And all of the, it sounds really kind of highfalutin when we're talking about it, right? It sounds kind of aspirational and sort of at a very conceptual level. But especially for middle market companies, these changes start to have very specific tactical implications for how businesses run. They have tactical implications for how you generate demand, how you market, and how you sell. They have tactical implications for the kind of data that you need about production. If you're a manufacturing company, you need deeper data now about what your production floor is working on, how fast they're working on, what your efficiency ratios are, all these sorts of things than you needed 6 months ago. It's likely to impact your gross margins much more directly than it did before, and you're going to have to manage it a lot differently than before. It's unlikely your entire management team is going to be able to walk the floor for every shift that you have, for every piece every order that's going out to the factory. You're not going to be able to have that sort of high touch environment in most cases anymore. So what does that mean? You have to have, you're going to have dashboards. You're going to have better KPIs to understand what's happening. You're going to have better planning and scheduling capabilities that all have implications on your systems and the types of management team that you put in place and all these sorts of things. And that's true for almost every company now.
Without violating any confidences, are there any anecdotes you can share with us about practical things that you have been able to bring to bear that have made a difference in companies?
So I'll tell you two quick stories about that. The first is relates to planning and forecasting. And the reason why I'll tell this first is planning and forecasting should be a very high priority for every company right now, no matter what size you are, no matter what business you're in. So this actually is a pre-COVID story, but it also deals with a structural and political shift that impacted a company. So we had a company that produced consumer products, and they produced them overseas in the Far East. In a number of factories, some of which they owned and some of which were joint venture and a couple of third parties. And it was a fairly low margin import business anyway, which means that the slight differences in import costs or duties and tariffs would make a big difference on their profitability. So the company was undergoing a shift in demand anyway from this is your typical brick and mortar to e-commerce sort of transformation where a lot of the components of your margin calculation change, right? And fulfillment particularly was becoming a much bigger cost for them to bear because you're shipping individual products out rather than big pallets of products, right? So they're importing all these goods from China. They're managing their gross margins very carefully because they understand that their fulfillment costs are much higher with this new mix of consumers, right? And then the tariffs started to be talked about, right? So this was back on the first round of tariffs on China. And that kind of abstract discussion, for those who were intimately involved in tracking the contours of the political debate around that, were very dynamic, and the percentages of the tariffs were changing. The categories of goods that the tariffs were going to cover were changing. And meanwhile, our client already had fairly limited margins and pricing that they couldn't control. The market basically controlled their margins. So the tariffs were going to mean the difference between them making money and losing money for going into Q3 and Q4 that year. So very quickly, we had to put much more rigorous forecast. We had actually already started this because it was part of their growth process, and good hygiene is putting better forecasting capabilities in place. And what they were able to do with the models that we had already built is start understanding what level of tariffs they'd encounter, what that was likely to mean for their cash flow, and what they needed to change for their product mix, for their pricing where they could control it, and in negotiating with their distribution channels in order to influence it. The first time we ran the numbers on the final tariffs, they went from about a 6 or 7% profit to a 3 to 4% loss, which was impacting everything: cash flow, profitability, enterprise value, the whole bit. So very quickly they used that information to look at their product mix, reallocate their buys to higher margin products, and then reallocate marketing dollars to higher value products. And what they were able to do by doing that is get ahead of the tariffs. Once they were enacted, the tariffs impacted them, but they were still able to stay cash flow positive. And because their supply chain was an 8-week supply chain, they had already gotten a head start on getting the products into the country that they needed to be profitable with the products they were selling, and kind of influence their whole revenue stream. So that's an example of where forecasting made an immediate short-term impact on their ability to be liquid and on their ability to generate positive cash flow. That's one story. Another story deals with a more broad range of changes to finance. We had a company that had a back office that was more aligned with what they were as a small first generation run company than a much larger third generation run company. And their financials were not terribly accurate. They didn't trust their numbers. It was taking them a couple of months to close the books, and it wasn't really a hard close. They weren't getting real financial statements that had accurate income information. And crucially, they didn't have any data about how they operated. And when we went and we looked at the data, we saw that there were operating metrics that were well below what they should have been. Things like on-time delivery percentages to their customers, things like close percentages on quotes, cost of quality. I mean, things that have a real measurable impact on the business's ability to stay sustainable and to grow. So over a series of projects with them, we got their close process down to a 5-day hard close. They're generating financials, reliable, high integrity financials every month. They have a accurate picture of cash several times a week, so that they can understand, what to pay, how to collect, how to manage other investments that they're making. And we brought visibility and real-time data around all of those other operating metrics that are important to them, like the ones I mentioned earlier. And as a result, some of those key metrics have gone up substantially. So on-time delivery, we were able to add 30 percentage points to on-time delivery, huge impact.
So really what you're doing in financial can spill over into the basic operation of a business.
You got to tie them together. You have to tie them together. You can make one-off kind of improvements on really burning platform types of issues, but to get full business benefit, the financials and the operations need to be looked at together, not in separate silos. And when you're looking at how to improve a business, you have to look at improving them together.
When you go into a business, do you still find that some are operating in the dark ages and really haven't brought automation to bear in executive functions, in finance functions, in managing the operational flow on their production floors?
I'll answer that a little differently. The short answer is, of course, yes. But I think from a consulting perspective, what we have to understand, and what I need to make sure my whole team understands when we go into a company, is that the question isn't whether bad decisions were made or decisions were avoided, right? The thing is that the people who are making decisions about how the company used to operate were making it based on a different set of assumptions than we have today. So our job is to gather information about what the business is now and what it's likely to be, and then help companies put a roadmap together to orient the company towards what that will be. It's not so much what's been done. Those were okay decisions when they were made. The question is it oriented to the company's future or not? And in a lot of cases, the answer is no. Most companies, especially now with the whole future reimagined topic that I mentioned earlier, right? Most companies expect to look different going forward than they used to. So that means that the things around automation, what they choose to insource and outsource, even the types of skills and capabilities that they choose to have people specialize in, are likely to be different going forward. If you're a company and you don't have somebody who's specialized in costing before, that's something that you're probably going to need to look at, because a lot of these high margin companies are going to have their margins change, and costing is going to become more important. Same thing with your back office. I mean, is the back office providing the insight around decision support, great forecasting, great scenario planning, scenario modeling, analytics around how you're operating and how the operations impact the financials? If they're not, you have to decide, whether you want to build those capabilities internally, whether there's some that can be outsourced, whether more of that back office should be outsourced. All of these sorts of things, because things need to change. There's change that's involved in all these things. There's investments that need to be made in technology. People need to be trained. In some cases, you need to bring in people with different skills. And all of these companies you can only focus on a few things at once. If you've got more than 3 or 4 strategic initiatives going on at any one time, you really need to reevaluate what people are spending their time on and what you're spending money on. So you have to understand with our help, and that roadmap, can you get there as quickly as you need to sustain the business and to grow the business?
When you go into a company, when your team first starts out, do you have any preconceived notions of what you would want to bring to bear, how you can help the company, or does that sort of evolve as you get to know the company better?
It evolves as we get to know the company better. I prefer to have us go into companies, pretty clean. And that's why we always start off with an assessment of some sort, whether it's a full business assessment or a finance assessment. We've got these rapid assessment frameworks that help us understand both the quantitative data and the qualitative data that we need in order to understand what the management dynamics and business dynamics are. Now, that said, there are certain things that do become themes company to company. There's, accounting is accounting. So there's efficient ways to do accounting and there's inefficient ways to do accounting, but good accounting at the end of the day is still good accounting, and we need to get there somehow. Forecasting and planning, like I said earlier, there's a certain level of short-term cash forecasting that everybody needs. So, to the extent that those would be considered preconceived notions, I suppose there are a couple. But, especially for big dramatic changes, we never go in, expecting to change. A really specific big example is, ERP projects, right? We never go in saying, oh, we know we're going to have to change their ERP system because of what they're running. That's too big of a project. It's too expensive, too disruptive, too risky to have that assumption going in. We need to really dig into the operations of a company before we make as serious a recommendation as that. The same thing with reorganizing. Changing leadership teams, especially in family businesses, reallocating them can be very disruptive. And in companies where longevity and loyalty and in some cases family relationship are important, even if you decide at the end of the day that those changes need to be made, you need to be very careful and very deliberate about the type of impact that those changes will have. So as good consultants, we need to make sure that we're gathering the information and making those decisions in a measured way before we recommend them.
So if I were in a business that was in trouble and I called you up and I said, hey, Steve, can you get over here right away? I need help. You're not going to be able to turn it around in 24 hours.
No, if you're really in trouble, we have a playbook that we can turn it around within, 24 hours, but 48, 2 or 3 days, we can start to put things into practice. Because if you're in crisis, there's a playbook for crisis. Remember, crisis management is supposed to be a short-term, sustainability related play, and we have a team of people that we bring in, hit the ground almost immediately and start executing those short-term things. I think the more careful recommendations start to happen during that recovery stage, and certainly planning for future reimagined, where you need to just take a little more time and be more deliberate.
And so as we close here, Steve, what is your message from Citrin Cooperman, from your division, for businesses trying to come out of the COVID era? And who knows when the COVID era really will end, but looking for the future, whatever that may hold.
The first is don't panic. Every piece of research coming out of the 2008 downturn indicated that companies that cut too deep or cut too reactively to the downturn in the economy they took longer to recover. Many of them didn't recover, and the ones that did were in a weaker competitive position in their marketplaces. So the first important thing to do is don't panic. Even if you need to make very short-term decisions and immediate changes, be sure that you have enough information about the context that you're operating in and the bare minimum of the financial changes that you need to make to get through the crisis and to sustain yourself. Okay, so that's one. Don't panic. Number two is get the advice that you need to make good, well-reasoned, deliberate decisions during the process. in that obviously coincides with the don't panic message too. Get smart people in the room who have seen this with other companies, who have seen it work and not work, to help you make those decisions and help you understand how it's going to play out. If you're a company that's already in recovery, or if you've been impacted on the good side where things are really taking off right now, you need to get advisors involved who can help you understand how it's going to grow, what your risks are, how to control those risks, and what's going to create the most value for you as the recovery plays out. And the third is avoid sacred cows. There's change is coming. Change is coming for everybody. And the change may still sound conceptual and strategic, but especially if you're a smaller business or a middle market company, that change is going to get real very quickly. And it's going to force you to make changes in the way that you operate at a very tactical day-to-day level, and how your people need to operate at a tactical day-to-day level that may be uncomfortable at first. And change management, how you manage the speed and depth of those types of changes and what you prioritize, will have an immense impact on the businesses and your team's capability of absorbing those changes and continuing to operate at a high level. So there's ways to plan projects. There's ways to plan rolling out changes, even if they need to be quick, that are more deliberate and more likely to pay off in the long term. And that's what we spend a lot of time working with our clients on, is how do we make, not only what changes do we need to make and how do we make them, but how do we make them successful and sustainable. And companies that have had a very difficult time with this in the past, that's more often than not where it's fallen down. So those would be my main three messages.
Good advice. And Steve Ronan, thanks so much for being with us today on this edition of Citrin Cooperman Corner Chats. I'm Peter Katz of Westfair Communications. Thanks very much, and stay safe. Join us again for the next Citrin Cooperman Corner Chats.